So this is August 2023, and we are starting with question 4. It's the question about inventory. But what do you need to know about inventory? Inventory is under IAS 2, and they can say you define what is all about inventory. And when we are talking about inventory, we look at 3 things. Number 1 is assets. Inventory can be defined as assets held for sale in the ordinary course of business. And if you're talking about assets held for sale in the ordinary course of business, those are like finished goods. Of course, at the company, you may be having these goods which you're keeping purposely to sell them. They are already finished goods, and they make part of your inventory. That is number 1. Assets held for sale in the ordinary course of business. Then number 2, the assets in the process of production for such sale. If we say assets in the production of, rather in the process of production, that is work in progress. Work in progress. If your assets are in the process of production, they are not yet finished goods, but already in the production, then they also make part of your inventory. Then lastly, we have raw materials. Raw materials or components you're going to use in the production process. Also, they make part of your inventory. So if they say you define inventory, then your definition must include these 3 elements. Okay? Assets held for sale in the ordinary course of business. Then number 2, assets in the process of production for such sale. That is your work in progress. Then finally, your assets that are in the form of materials or supplies to be consumed in the production or in the production process. That is all about inventory. Okay, but here with IAS 2, okay, before I just bring in IAS 2, you just need to know that as we account for inventories, the general rule is that we value inventory at historical cost. As you account for inventories in your financial statements, we value inventory at historical cost. That is general rule. Okay. But some situations may demand that we actually apply or we compare 2 things. That is, if you cannot apply general rule that is varying your inventory at historical cost, then we look at 2 things. Number 1, you're going to look at the cost. You compare 2 things, that is the cost and NRV. That is net realizable value. Net realizable value. We compare 2. We compare 2 things. That is cost and net realizable value. If you cannot tell the net realizable value, then it means that as you value your inventory, then you are going to use historical cost. The cost we are talking about here is historical cost. At how much did you actually incur when you were purchasing those inventories? That is historical cost. But in some situations, you may need to compare that historical cost with NRV. depending on the question you're handling. But what is this NRV? NRV is equal to estimated selling price. Then you subtract estimated costs to sell. I can just say costs to sell. That is how you can get NRV, net realizable value. With cost, you don't need to apply any formula because this is historical cost. But with NRV, you look at two things. You just get your estimated selling price, then you subtract cost to sell. Okay, so we are going to use this knowledge to answer some calculation number. Here. This question 4, when you look at the required part, they are saying we calculate the closing value of each item of inventory, and hence you determine the total value of closing inventory for these items for Tojo Limited at the year end. So the case study, they are telling us that Mr. Toko, okay, the managing director of Tojo Limited, has a number of specific queries in the relation to inventory and has asked you to advise in relation to IAS 2, that is inventories. As part of its overall inventory, this company has 3 items of inventories whose cost and net realizable values are as follows. So you see that in this question, you are given net realizable values. You're also given the cost direct. You have the column for costs, you have the column for net realizable value. So for you, what you're going to do is to compare, because you know the rule is to compare. The moment you have net realizable value, then you must compare that net realizable value with the cost. But at the end of it all, what are you going to take as your value of closing inventory? If you compare cost and net realizable value, the standard says that you must take the lower between cost and net realizable value, compare and take the value which is lower. That is the general rule. Okay. So it means that when you're answering that part A, you just need to compare the cost with net realizable value for item number 1. Ask yourself, between this and this value, which one is lower? So it means that we can create our table, we can get your book and we answer another column, and I call it closing value. Closing value. For you in your books, you can just write the whole of it, and we are comparing the cost with net realizable value. Which figure is lower? If you compare, you see that the figure that is lower is how much? 2,160,000. So that will be your closing inventory, because the rules say that you compare the cost and net realizable value, then take the figure that is lower. So it means that for item 1, as you record in your financial statement, then you should record it at this value. you should record it at this value. Then for item number 2, we also compare the cost with net realizable value, and the lower is 1.44. Then the last item, the lower figure is how much? If you compare this and this, then it is 2.76. So we have answered the first part, that is the closing value of each item of inventory. We have answered that. Now we can tell the closing value of item number 1, item number 2, and item number 3. But here they are saying you go ahead and determine the total value of closing inventory, the total value. So it means that if you're looking for the total value, what you're going to do is just sum up and get the total value. So this is our total value. This is our total value. You can say the total value of closing inventory is equal to shillings. Then you write this figure. Any question at this point? Is it clear?
Yes.
That's all about 6 marks. That's all about 6 marks. You're done. That's all. Okay, that's all. So it means that every time you have cost and net realizable value, just compare and take the lower. And you just need to know that as we record our closing inventory in our financial statement, record the total value. So if you're told to record the value of closing inventory in your financial statement, then you record this. Okay, so that is the first calculation number about this. But there are some situations you'll find that you're not given NRV direct. Okay, there are some situations you'll find that you're not given NRV direct. And if you're not given NRV direct, then you apply this formula. So allow me to also handle another calculation number, then we apply that concept. And we are going to use this question. We are going to use this question. I know some of you attended the physical session, but those who missed it, let's use like 5 minutes to answer this. So this is the case study. Part A is theoretical types of inventories that are not covered. We are going to talk about it. Then part C is also advise this CEO on how we are told to advise this CEO on how the above inventory should be measured, clearly giving the value at which the inventory will be recorded in the financial statements. Okay, we need the value. And we have different inventories, that is A, B, and C. We have the cost. The cost will always be given. the cost will always be given, and this is historical cost. But here, this next column, we are told that this is estimated selling cost. This is not NRV, this is estimated selling costs. So the question is, are you given NRV? No, you're not given NRV. Can you get NRV? Yes, from which formula? Estimated selling price minus estimated selling cost or costs to sell. But do you have estimated selling price? In this question, we have estimated selling costs. We don't have estimated selling price. So how are you going to get estimated selling price? You're going to read this paragraph. They are telling us that he further learned that this company usually earns a margin of 25% on type A goods. That is like your profit. This is like your profit on type A. Okay? And if they say margin of 25%, in terms of profit, we say that that is 25% of your selling price. Margin is always on selling price. Then markup is always on cost price. So it means that you're going to use this paragraph to come up with the selling price. Okay? So we can answer this. Next question. Next question, we are given margin. We are given a margin of type A. Type A is margin at which percentage? At which percentage, colleagues?
25.
25%. Then type B, we are given what? Type B is also margin or markup?
Markup.
Markup. At which percentage?
15.
15%. Then type C, is it on margin or markup also?
Markup.
Markup, which percentage?
15.
It is also 15.
Yes.
It's 18.
Michael, read the question very well. Markup is 15% on type A, rather type B, then 18% on type C, because they say the respective rate. So it means that 15 is for type B, then 18 is for type C. So this is 18%. No, Michael is scared, but don't be scared. Don't be scared, you will pass this subject very well. So if you're given such kind of statement, it is going to help you. It is going to help you to come up with. It's going to help you to come up with the selling price. Recall that as you determine your selling price, selling price, colleagues, if you want to determine your selling price, we always say that selling price is equal to the cost, then we add profit. As you determine, if you're in a company and you want to determine your selling price, at how much should you charge your commodities? If you want to determine the selling price of your commodities, you immediately think about this formula. Of course, the first thing is to know how much did I incur on this item. Then what do I expect as my profit? You want your profit to be based on the cost or to be based on the selling price? If the profit is based on your selling price, then that is you're going to apply margin concept. If you want to get your profit based on your selling price, then you determine the percentage as your margin. Okay, so if they say margin of 25% and you want profit, always know that here the profit will be 25% of your selling price. Then if it is markup, then the profit will be 15% of your cost price. Even here, your profit will be 18% of your cost price because it's markup. Markup, those who attend, I said, if you want to recall these things, just recall the formula MACO. In commerce, we used it to recall these things, MACO. To know that the moment I see markup, I think about MACO. MACO, then I should know that the percentage given is on cost. Then the opposite will be your margin. Okay, so we are going to use this knowledge to come up with the selling price, because in the question, colleagues, we have just estimated. In this question, we just have estimated the selling costs. We have also costs. So for type A, I'm going to say let may be X. Colleagues, don't hate X, okay? Where we have selling price, we put X. So this is X. It will be equal to the cost. Do you have cost for type A in the question? The cost for type A is 11.8 million. So where you have cost, put 11.8 million. Then I'm going to add what is our profit? Because the formula is saying add profit. What is our profit now? Remember, for type A, it is based on what? Type A is based on margin. So it means that where you have profit, I'm going to put 25% of selling price. 25% of selling. 25% is the same as 0.25. Do you have selling price? No, the selling price is X. Let me hope you have understood this. It is 25% of selling price, but I don't have the selling price. Why do we use cost and not estimated selling costs? Colleagues, the estimated selling costs are just going to help you to determine NRV. Recall our formula. Our formula for NRV is estimated selling price minus costs to sell. Costs to sell are the same as estimated selling costs. Costs to sell are the same as estimated selling cost. So as you determine your selling price here, the cost you're talking about here is the original cost. It's not estimated selling cost. This is historical cost. You understand the difference. Eh? Someone who has in the chat. I hope it is now clear. Don't confuse this cost with this one. This cost is cost to sale. Then this one is historical cost. Okay. So we need X. How can you get X? We'll come this side minus 0. X minus 0.25. X is equal to this one. So if you get X minus 0.25X, what do you get? Michael, X minus 0.025X, what do you get?
I
Here you
have no
have,
idea.
pardon?
It is 0.75x.
0.75X. This X, this X is like 1X. Eh? We cannot just write 1X. No, it doesn't make sense. We just write X. So if you're getting 1X, it's like you're getting 1 minus 0.25. Then you will be in position to get 0.0. Okay, so we can get estimated selling price for type B. You can just say let your Y be the selling price for type B. This is your Y is equal to what is the cost for type Y? In the question, original cost is 18.05 here. Recall that we record the original cost, 18.05. Then we add our profit. The question is, what is our profit? Remember, for type B, it's on markup, okay? And we said that the profit will be equal to 15% times cost price. 15% times cost price. This is the original cost, okay? So since you have the cost price, you're going to just get 15%, then you multiply the cost price, which is this one. It's 18% times the cost price, which is this one. I will be in a position to get profit direct. Then finally, what will be my selling price? I just add. I get this plus this figure. That will be your selling price for type B. Is this clear?
Pardon.
Okay. Recall we are substituting in our formula selling price. Selling price is equal to cost plus profit. The question is, do you have selling price? No. Your selling price is Y. So Y is equal to, do you have cost? Do you have cost? The cost is given in the question. The original cost. The original cost is here. This column, this one here. 18.005 million. That is our cost. I write 18. That is my cost. Then I add what? I add profit. Remember, for type B, we are using markup to determine profit. This is type B. We are using markup to determine profit. And what is your profit? You're going to get 15% times the cost price. The cost price we are talking about here is this one. This figure you are seeing is your cost price. So it means that as I get my profit, I'm just going to get 15%, 15%, then I multiply the cost price, which is equal to what? 18 million 50,000. Then I add 15% times what is my cost price? The cost price is this one. So this figure you are seeing here is your profit. This figure is your profit. So to get your selling price now, you will simply add. You get this plus this. Your cost plus profit. You'll be in position to get the selling price. Is it now clear?
Yes.
Is it now clear to you all?
Yes.
Okay, so we can get also the selling price for type B. We can say let ZB our selling price for type B. Also, recall our formula to get selling price. Selling price is equal to cost plus profit. You don't have selling price, I call it Z, is equal to my cost. What is the cost for type C? 17 million one cost. 17,110. $17,110,000. Then I add my profit. I add the profit, and the profit is what? They said also type C. Type C is also, the profit is based on markup. So we are going to get 18% times the cost. 18% times the cost, which will be equal to this figure plus I get my 18%, then I multiply by the cost. The cost is this one, 17,110,000. That is your cost. So the figure you see here is like your profit. So to get selling price, I get cost plus profit, which will be equal to this plus this. And that is your selling price for type B. So it means that finally what you're going to do is to compare, is to look for NRV. What is NRV for type A, type B, and type C? Recall that we need NRV, net realizable value, which is equal to, if you recall the formula NRV, it's here. The formula is here. So let's get NRV. Let's get the NRV. So for type A, do you have estimated selling price? Estimated selling price for type A is this one. So we get this figure, this one. Then we subtract estimated selling costs. Estimated selling costs in the question, it's here. Maybe someone who can tell me as I write. Tell me as I type. It is how much?
The selling
302
It is 30
21.
500. So that is my selling, that is my NRV. Let me hope that's what you have. I am getting estimated selling price. Already we have the selling price for each type. This is for type A. This is for type A. This is for type B. Type B. This is for type C. So I'm getting this, the estimated selling price, then minus estimated selling costs. For type B, the selling price is this one minus, tell me the estimated selling costs for type B. 3.1.
3860,500.
3860,500. 380,500. Ah,
3860.
380,500. Okay, that's what I have as my NRV. Please use your calculator to confirm whether you have the same figures. Then lastly, I get this minus the last figure is 3.1.
Yes.
So that is my NRV for each type. That is my NRV. So once you have your NRV, you can compare your NRV with historical cost. This is A, this is B. Please, if there is a question, ask. If you have, let me hope you are okay about this, how I'm getting these values. Anyone who needs some clarification?
Yes.
To get NRV, I am getting estimated selling price. This is our estimated selling price here. The working we are doing here is to get estimated selling price. This is estimated selling price for type A. This is estimated selling price for type B. This is estimated selling price for type C. But to get NRV, the formula is get that estimated selling price and subtract the estimated selling costs. That is costs to sell. So it means that to get this value, you're getting your estimated selling price for type A, which is this one, then minus, let me hope you have your calculator. Get this value, then subtract estimated selling cost. Estimated selling cost for type A is this figure. So get your selling price minus this figure. Confirm whether you're getting this. Someone who is saying I clarify. Confirm whether you're getting this on your calculator.
Yes.
We are getting this figure minus the estimated selling costs in the question. Mike, are you getting this figure? This figure?
Yes, yes, I'm getting.
Are you now okay? Also do this, get the selling price minus estimated selling costs. You do the same for type C. Okay. So here you have cost, then another column for NRV. Then I can call the last column for closing volume. The cost for type A have this in the question. You have this in the question. For type B, you have this. Then for type C, the cost I have this. I have NRV for each. NRV for type A. Then for type B and type C. So this is like the first question we did. We have cost and NRV. And we are interested in getting what? Closing value. Let me pick someone here to tell me the closing value. Someone called D can tell me the closing value for type A. What can I write as my closing value for type A? You have cost, you have NRV. The question is, what is your closing value? What can I write between this and this? Person called D is quiet.
Who left it?
11.
So, colleagues will record the rower. Compare cost with NRV, then we record the rower. So the rower figure is 11.8. Do the same for type B, record the rower figure. Here you have 18, here you have 16. The rower figure is this one. Then for type C, the rower figure between this and this, the rower figure is this one. So finally, we can get total value of closing, total value of closing inventory. So the total value, I just sum. Total value if you sum, how much do you get? If you add, you add this. For you can just add using your calculator. Let me just sum. So that is my closing value. You get this plus this plus this. And that's all. That's all for this question. 10 marks. Any question? Any question about that? Someone saying kindly explain on how to get margin. Margin, the percentage will always be given. They are saying like here margin of 25%. So if they say margin of 25%, just know that that percentage is going to help you to get profit. But how do we get profit when we are given margin percentage? To get profit, you get that percentage, we multiply by the selling price. Margin, if they say margin, recall the selling price. The percentage given is on what? On the selling price. If they say markup, then the percentage given should be on cost to get profit. Here, this is the working. Here we are given a margin as 25%. You need profit. So how are you going to get profit? Profit will be equal to 25% times the selling price. You multiply the selling price because you're given margin. You multiply here the cost price because you're given markup. That is just the logic. And to differentiate is that in an exam, if you're confused, if you are confused, then recall this word markup. To know that if I have markup, then the percentage given should be based on cost. Markup, this last CO stands for cost. Then the opposite, you can easily recall now that for margin, it should be on selling price. Simple, simple. Just you need to recall this. But all this, what you're trying to get here is to help you when you're determining your profit. Because wherever where you have profit, you'll be just substituting this. You'll be just substituting this. Someone in the chat, are you okay now? So that's all about cost and NRV. Please, if there is a question, you ask. I'm done with this area. Done with this area. The theory, I shared the solution for part A and part B. And it is even in your handout. But part A, to explain types of inventory that are not covered under IAS 2. We have work in progress under construction contracts. Colleagues, if they say you explain types of inventory that are not covered under IAS 2, that is part A. Remember, now here you have the first part. Inventory that are not covered under IAS 2. Then you also have this question that you explain types of inventory that are exempt. These are two questions. These are two questions, colleagues. First question, inventory types of inventory that are not covered under IAS 2. Then inventories that are exempt from the measurement rules of the standard. If they say those ones that are exempt from the measurement rules of the standard, it means that here they are telling you, you give those inventories, or you state those inventories that are not covered anywhere in the standard. We have different standards, have different standards. Types of inventory that are not covered. It's covered under IAS 2. Number one, it's work in progress under construction contracts. Work in progress under construction contracts. These are not covered. This kind of inventory is not covered under IAS2, but it is covered under what? It is covered under standard code IAS 11. Accountants, you need this construction. This standard talks about construction contracts. It is not covered under IAS2, but it is covered under another standard called IAS 11. International Accounting Standard 11. Then number two, you have inventories under financial instruments. Inventory under financial instruments. Financial instruments here include shares, bonds. Those are financial instruments. And this one is covered under IAS 32. It talks about financial instruments. Then lastly, you have biological assets. Biological assets. These are related to agricultural activity and agricultural produce at the point of harvest. At the point of harvest. This is not covered under IAS2, but it is covered under IAS 41. IAS 41 talks about agriculture. So colleagues, these are the only types of inventory that are not covered under IAS2. Okay. Colleagues, if they ask, you don't need to state this one, especially if you forget. Just list like this. But if you can recall, you say that the first inventory that is not covered under IAS2 is work in progress under construction contracts, but it is covered under IAS 11. That is if you can recall. But if you don't recall these ones, just leave. State only these points. Then next, types of inventories. Types of inventory that are exempt from any standard. Number one, we have inventories held by producers of agriculture and forest products. Colleagues, if let's say you have harvested your things, just you need to just apply in at the time you're going to sell. Then the value of that asset, the value of that produce is your amount for inventory. You don't need to apply any standard here. We are talking about inventories held by producers of agriculture and forest products. 2 is the inventory held by commodity broker traders. Inventory held by commodity broker traders. That kind of inventory will always be measured at fair value, less cost to sell. So those are the only two types of inventory that are exempt. Let me hope you have recorded that. Okay. Then last question. Explain the circumstances under which the net realizable value of. Please repeat the first one. Okay, sorry about that. Here we have inventories. Let me just maybe write. Inventories held by producers of agriculture it can be of agriculture and forest products, but here we are meaning after harvest. Let me just summarize after harvest. Okay, then here we are talking about inventory held by commodity broker, commodity broker, concept trader. Those are the only two types. Here, if you want to value such kind of inventory, the one held by the commodity broker, you just look at the fair value, then less cost sale. The figure you get will be your value of inventory. If you are in the if it is your inventory, let's say if you're in the business of selling motor vehicles, then that is that is like your finished good. It can apply under IAS 2, depending on maybe how you are looking at it. If you're in a business of selling, remember IAS 2, we said it covers finished good here. Can be part of your inventory. Can be covered here. But let's continue. Explain the circumstances under which the net realizable value of inventory may fall below the cost. Who wants to try? Under what circumstances may you find that the net realizable value is less than the historical cost? We can just summarize.
Obsolescence.
Number 2, this means what? Then number 2. Point number 2. Point number 2, let's be fast.
Obsolescence means like when something gets outdated, you just go to this inventory, but you just reach on market and it's outdated.
Perfect. Then next point. Where there is overproduction. No, this is the theory. You have to defend your point. Now, overproduction. You can help us to understand this.
where we have overproduction, that means there are a lot of goods in the market, leading to a fall in price. So you find that traders are selling items way below the cost in order to get rid of these items.
Okay. So colleagues, okay, you can list all your points, but you have to explain, okay? You have to explain. You have to explain. Someone is saying in the chat, change in tests and preferences. Yes, it is right. Okay, I think that's all. You just needed to state the point and defend yourself. And that's all about this question. And as we prepare for our exam, obviously we need to know that this area, of course, they cannot just ask like that minus a theory, so prepare for theory. I don't know whether we can handle another part that talks about inventory. There is a calculation number related to using the FIFO, and the weighted average method, because these days we don't apply LIFO. It's only the standard is amended, and we only now apply FIFO and the weighted average method to value the inventory. Okay, FIFO stands for first in, first out. So I don't know whether you all understood these things. If you all understood, we can leave out and we handle the compulsory number. But if you need it again, talk about these methods, then we might not get, unless if you want to sleep. So can we handle a question related to this, or you are okay?
Take us through, please.
Okay, so we are going to use one question. We use just a question to apply these two concepts. Here, which year? This is May 2022. May 2022. You see the theory, 6 marks. Explain the inventory. When they say inventory, look at 3 things. We have discussed this. State the costs that should be included when measuring the value of inventory. Can we summarize this also? Before we go to, you can we summarize? Anyway, the costs included, you have 1 cost of purchase. Costs included, we have 1 cost of purchase. And when you're talking about cost of purchase, you look at purchase price, you look at import duties or any non-recoverable tax you're going to pay. Also the transport costs associated with your purchase. Then number 2 is cost of conversion. Number 1 was cost of purchase. Number 2, cost of conversion. Cost of conversion, those are costs directly related. Yes, please.
Where are we at? Somehow, some of us lost you.
We are here, we are answering this.
Okay.
Costs which state, we are told to state which costs should be included when measuring the value of inventories. And I said 1, you look at the cost of purchase, that is number 1. Number 2, the cost of conversion. Cost of conversion, here we are talking about costs directly related to the production of finished goods. Maybe direct labor, direct materials, those costs you're going to incur. Then the last item is other costs. Other costs, you're going to find that you're talking about costs incurred to bring the inventory at its present location and the condition. And you have also these things in your handout. You can check and read more. The costs that you should not include, they can also ask you the costs that should not be included when measuring the value of inventory. And number one is like your abnormal amounts of wasted materials, labor or other production costs. Those abnormal costs are not included. Also, storage costs are not included unless for the production process. But the one after, maybe you have produced it and the product is finished good, then if you incur the storage cost on your finished good, then that cannot be part of your inventory. That will be just like your expense. So storage costs not included. Administrative and selling costs are not also included. Okay, so we handle calculation number. So here they are telling us Mango Limited values its inventories of engines using FIFO method. As at 31st January 2021, the company held an inventory of 140 engines, which cost shillings 6 million each. Below are the inventory movements during the year ended 31st December 2021. These are inventory movements, okay? Whatever you have below. So you have your, from January to November, you have units purchased, unit price, unit purchase price, units sold, unit selling. And they are telling us we calculate the value of closing inventory as at 31st December 2021 using a store's ledger and a FIFO valuation method. So you can open your book. We are preparing Mango Limited store ledger, stores ledger, but using FIFO, because you can use, as you prepare this ledger, you can use FIFO or you can use weighted average method. Okay, so here we are using FIFO. Remember that in practice, as a company, you must be using one method. And this method must be consistent. You cannot keep on changing. You must state in your policy that it is the policy of the company to actually value the inventory using FIFO method. If you state that, you must be consistent. You cannot keep on changing. Okay. Or if you want to change, state the reasons why you want to change. But it should be consistent for comparison purposes. Okay, then we are preparing for the year ended 31st December 2021. You must know the format, the template, how you should be in a position to lay out in an example.
We are done.
Okay. So once you lay out your template, I'll go back to the question. They are telling us that as at 31st December, as at 31st January 2021, the company had an inventory of 140 engines. It means that these are either inventory units 140, which cost shillings 6 million each. But here they are telling us in the month of January, units purchased are what? Are 20 at what? At this. So what does this one mean? This is the opening inventory at 6 million. 6 million, then the amount will be this times this. Then if another person is using the other assumption is that if let's say this is correct, then I will determine the sales. I look at what was purchased during the year, purchased 20 during the year. But now it is also confused. Then this angle I see it is not coming out what I'm trying to mean. It is not coming out to know what the units sold. Let's just go with this. Maybe I will analyze it later about the angle of sale. But I'm assuming this 140 is my opening inventory. The year commenced when they actually had 140 as opening inventory. And the value of that 140 is at 6 million. Then still in January, they purchased more units, 20 units at how much? They purchased at how much? 20 units at this figure, the unit purchase price. So where you have unit cost, I record the purchase price. This is 6.4. Since I'm keeping 3 zeros, .4. Okay, if you multiply, what do you get? This times this, you will get this amount of money. Then the question is, initially the math is starting when your balance is units 140. Then you have purchased more 20 units. It means that the balance will increase. You get 140 plus more 20, you will get 160. Then what will be your amount now? The amount will be the new amount. This amount will increase by getting the previous amount. Then we add this amount. So the unit cost, if you want to get the unit cost, you just simply get this divided by 160. The next batch, that is which month? March, you purchased more 20 units, and each is 7 million.
50.
So 57. Purchased more 50. Oh, yeah. Purchased more 50. Where did the, oh, let me repeat. This is the unit cost. Initially, when you're handling this colleagues, when you're handling this, on the balance column, simply first get the unit and the amount before getting unit cost. First get your units, then also your amount. Once you get your amount and unit, you'll be in a position to get unit cost by getting this figure, the amount divided by the unit. I will explain more when we are handling sales. But let me hope all of you are okay about this, how we are getting these values. Are you all okay at this
Yes.
point? Okay, let's go to the next batch. The next batch is coming on which day or which month?
March.
March. So I will record here. I can, maybe for you in your books, you can put a line, me I can leave a space. I put here March. March, is it a purchase or sale?
Purchase of 50 units.
So I write here 50 at how much?
7 million.
So 7 million. Since I'm keeping 3 zeros, I just write 7,000. So if you multiply this times this figure, you will get it. So when we go back at our balance column now, this is our balance column now. Units will be how many? Previously, we had 16. I add 50. Then the balance, previously, this is my previous balance is that. Then I add this amount because you're purchasing, your value has to increase. Okay. Now, after getting my balance, if I need it, if you want to get unit cost, simply get the what? Simply get this divided by this. Okay. Then the next batch, is it about which month? The next batch? May. May is talking about now what? Sales, units sold. So what does that one mean? This is May. Units sold are how many? Units sold are 120. But of course, this is first in, first what? First in, first out. You first ask yourself, what was your initial batch? Initial batch is 140. We started with 140. You cannot sell 20 units. 3 million. So the overall amount will be 120 times this. Okay, so the question is, what will be my units left in the store? Because here you are selling, you are not purchasing. Since you're selling, the balance must reduce. Initially, your balance was this, so you're going to get 210. You subtract 120. So this is the balance remaining amount. I subtract this amount. I want to get the unit cost. I simply get this divided by this. Okay, the next batch, next month is what? Come again, please. Okay. Okay, colleagues, you observe the question. They are saying in May, the company sold 120 units in May. You need to ask yourself, where are you going to pick those 120 units? Remember, it is first in, first out. You cannot sell these 50 units when you actually had some opening units in the store. You first remove those units you purchased at first. The units you purchased at first must be sold first. That is first in, first out. So I'm going to get my 120 under sales. I write 120 here. Then I ask myself, at what cost? I'm selling these 120 units at what cost? Or I'm going to value these 120 units I'm selling at what cost? So you ask yourself these 140 units. What about the amount? Let me hope the network is clear, colleagues. Confirm. Confirm before I
can hear you.
continue. Okay. The amount, how are you going to get the amount? You get the previous amount, then subtract, because this is a sale. If you're dealing with sale, you need to know that the balance column you must subtract. Then you're dealing with purchase, of course, your units will increase. You have to add. Even the amount will increase, you have to add. But since it is sale, your amount must reduce, also your units must reduce. So I'm reducing this value by 720,000. Let me hope someone in the chat, you're now okay. And to get my unit cost, I simply get the amount, I divide by the units. And I can round off to the whole number. Table on the sales unit. We are recording this 6 million, not 10 million, because obviously it means that at the end of it all, the balance, that balance will help you to actually get what? Will help you to actually get profit. Help you to actually get profit. Because if this is the actual selling price, and initially you had purchased these units at 6 million, it means that ideally that remaining 4,000 your profit. Million. Rather, yes, we don't record this. We don't record this. We record this only and only when we are determining profit. Is it clear? Daniel, is it clear? Let's continue. Let's continue to the next batch. Next batch, that is June. Again, there is what? There is sale.
Abel,
Yes, yes.
that part of the 6 million is not clear. I think on our side there was a network issue.
This 6 million, it is not clear. It's because we are using people. Ask yourself, where are you picking these 120 units? You are picking these 120 units from the first batch in the store. And the first batch in the store is 140.
Yes.
So you are picking, as you said, we are saying the first in, first out. The first materials you purchased should be sold at first. So it means that if at first I purchased 140, as I said, the first sale I should first complete this one. I should first complete 140. Just selling any other. So once you know that you're picking 120 from this, then you ask yourself, these units were valued at how much? As you were purchasing those units, each unit was at how much? And you can observe that it is at 6 what? At 6 million. And this 6 million is coming from where? It is coming from this statement. This is where we are getting
Yeah.
6. I hope now it is clear.
Yes, it is. Thank you.
Let's go to the next batch. The next batch, that is June.
Offer comes from the amount.
June,
Comes from the amount. You get this, you divide it by this, and it gives you the unit cost.
colleagues, June, there is also sale of how many units? 30 units. Where are you picking these 30 units? Kindly mute.
From the old stock.
Yes, from the old stock. Remember, out of 140, we picked 120. So it means that we have our balance of 20, we first record 20. I first record 20 in the column of units here. I record 20. At how much you're picking these 20 from here. And these units were valued at 6 million. So I record 6. I record 6 million here. Remember, in June, you're selling 30 units. So it means that you need also to pick 10 units from the next batch. Now go to the purchase side. When you're handling this, once you're done with this, now go to the purchase side. The next batch was, you purchased 20 units. So out of 20 units, you're going to pick what? You're going to pick 10.
10.
And you're picking 10 at how much? At 6,400.
6.4.
Okay, 6.4. So I will get 20 times this 6. And here I get 10 times. Before I continue, kindly, if there is a question, ask. Are you all okay about this?
Pardon on that entire June.
June. Remember, June, we are selling 30 units, okay? We are selling 30 units. The question is, where are you going to pick those 30 units? First in, first out. Out of 140, you sold 120. So it means that you have 20 as your balance. So you first sell those 20 units. I'm picking 20 units from here at this 6 million. But because I'm selling 30 units, it means that I need to go to the next batch. After picking 20, I go to the next batch. The next batch is this one. Out of 20, I'm going to sell 10 units. If we add here, you get 30. Then also add here, you get this figure. plus this. And how can we get the balance? Remember, you had 90 in your store, you are selling 30. So I get 90 minus 30. Then for the amount previous balance is this, then I subtract this amount of, and that will be all for June. Then to get unit cost, it is very easy. You just get the amount divided by the units to get the unit cost. Like here, if I want to get the unit cost, I simply get the amount, I divide by the number of units. Okay, the next batch. Next batch, that is September. The company is purchasing more 60 units. So I record this is September. This is September, the purchase. If it is purchase, please put the units under the purchase column. We are purchasing how many units? September, 60 units.
60.
At how much? 7.6. This is 60. I write 60 here. This is 7.6. Okay. Then I get the amount by getting 60 times this amount of money. Who can tell me now the balance in the store? I want to hear from you. Now, what is our
120.
balance in the store? The units?
120 units.
I get 60. I add 60 because this is purchase. Then amount, you also add. You get the previous amount, this one, then add this amount. Then to get the unit cost, if you want, you just simply get this divided by your units. Okay, then we go to the next batch. Which month? November. How many units are we selling? Oh, for November, we have units sold. We have units sold. Now, this is where the issue is. Understand, colleagues. Now that in November, you're going to sell 30 units. But where are you going to pick these 30 units? Remember, it is first in, first out. The units you purchased first should be sold first. That's why it is called first in, first out. So, where are we going to pick? We had some balance somewhere. Here we had, actually you can write. Here we had how many balance, how many units as balance? We picked 10, isn't it? We picked 10 and the remaining balance is 10. I can first write 10. I first write 10 here. At how much? You ask yourself, each unit here was valued at how much? Remember, you're picking 10 from here, but each unit was valued at how much? 6.4. So you write 6.4. But remember, we are selling how many units? 30 units. So we are left with what? 20 units. we need 20 units from the next batch. So here we have no business, we go to the next batch. And the next batch in the store is this one. So out of 50, you are going to pick how many?
20.
Michael and the others. Bira, you are quiet. I don't know. Bira.
20.
Okay. So we pick, out of 50, we are picking 20. At how much?
At 7 million.
At 7 million. Perfect. So you now get the amount by multiplying. Simply get 10 times this. Also here get 20 times 7,000. So I can get the total here, 30. Then I also get the total amount. Simply get this plus this. Then I go to the balance column. How many units now in the store? I get the previous 120. I subtract 30. Then the amount, I get the previous amount. I subtract this amount. Then if you want the unit cost, you simply get this figure divided by 90. Do we have any other item in the question? Okay, that was the last part. So once you're done with that, the value, the total value of closing inventory is the shillings. How much? Who can guess? The total value of closing inventory is simply, you write this. The last balance. That is your total value in amounts. Then the inventory in the store is this one. The closing inventory is this one. Each valued at this amount of money. Any question? Can we summarize also how to use the weighted average? With weighted average, it is very easy. It is not like before. Is this one, weighted average method. Colleagues, with weighted average method, okay, the format is the same. Maybe I can just copy some few things. Okay. That is my format, my template. Opening balance, it is the same. The only difference, colleagues, the only difference is when you're handling FIFO, you look at the first batch, the first batch or the first units you purchased to determine the unit cost on your sales units. But with weighted average, you're going to see that actually we don't look at the first batch. We only look at the unit cost, the previous unit cost. Like now here, we want to know January. You started January with how many units? 140. 140, each at 6 million. The balance you just multiply. Amount you just multiply. Just so yeah, you purchased 20, each at how much? I'm just copying these figures. They already have, you need to ask yourself, how can I handle? Which unit cost can I use? But other things are the same. Here you just add. If you purchase, the balance will increase. If you sell, the balance will reduce. Here the balance is going to increase because there is a purchase. Then here the balance is going to increase because there is a purchase. And with this method, colleagues, it is a must. You must get unit cost here. As I said, with first method, this column is irrelevant. With first method, with people, this column is irrelevant. But with weighted average method, this method is very, very key. Very, very key. So you must get unit cost using the same knowledge. By getting the amount, divide by the units. You can always round off to the whole number. Then next batch is which month? March. March. There is a sale or what? March. There is also purchase. Okay, 50. More 50 at how much? At 7 million. If you multiply 50 times this, since this is purchase, your balance must increase. You get the previous number of units, then add 50. Also, the amount must increase by getting the previous amount plus this amount. Then how are you going to get the unit cost? Get amount divided by number of units. Colleagues, are we at back?
Yes.
So next batch is, okay, May, this is sale. Whenever you say sale, whenever you see some units sold, ask yourself now, you're going to value that batch at how much? You're going to record how much as unit cost. When you're using weighted average method, things related to first in will not apply. Just write 120, simply write 120 direct. This is May, simply write, where you have units, simply write 120, then the unit cost pick the previous unit cost under balance column. We pick the previous unit cost under balance column. Just pick this figure as your unit cost. So whenever you see units sold, it means that you will pick the previous unit cost under your balance column. Just get 120 times this. Then units, how many units now left in the store? You get the previous balance minus this. Then for amount, you get the previous amount minus this figure. But you don't need to record decimal points. You can always round off to avoid the confusion. You can always round off the whole number. Are we at par? How we are getting this and this? Since this is sale, the balance must reduce. I'm getting 210 minus 120. Here I'm getting this amount minus this. Then how are you going to get unit cost? You simply get the amount divided by 90. Okay, next. Next, which month? May, we go to June. June. June, there is what? Let me see. Units sold. I simply write I simply write 30. Then I ask myself, what is the unit cost here? Which unit cost should I record? Who can try?
6276.
We record the previous unit cost under balance column. So this is the previous unit cost. I record that. So I'm going to get 30 times this figure. So the balance, the number of units are going to reduce. 90 minus 30. Also, the amount is going to reduce. This minus this. Can round off to the whole number. And I can get here the unit cost by simply getting the amount divided by the number of units. Can also round off to the whole number. Then next, September. September, do we have sale or purchase? 60, we purchased 60. With purchase, you record the purchase price at 7 million. Then here I'm going to record the 60 times. Okay. Who can tell me now the balance? Here, how many units should I record?
Abel,
Yes, please.
was it 7 million or 7.6?
Let me check. In September. September. Oh, it's 7.6. September 7.6. Thank you. Okay. Then now, what is our balance here? This is 7.6. Then here, what is our balance number of units in the store? How many? We get 60 plus 60. Then the amount, we get the previous amount plus. Then here I'm going to get this divided by 120. Hope you are picking. This is if there is a question asked. Then next, that's item November. There is the same. November, I'm going to write here. You simply write the number of units sold direct. It's not like FIFO where you have to first pick the balance, record that its original amount. For weighted average method, you simply write the number of units sold direct, which is here we are selling how many? You are selling 30. So I just simply write 30. Here I write 30. Then the unit cost, I pick the previous unit cost under my balance column. This is my balance column, unit cost. This is the column for unit cost. So I pick the previous the previous unit cost, which is this one. So I'm going to pick this amount of money. So finally, we will say 30 times. And the number of units remaining in the store, 120 minus 30. Here, you will get this figure minus this. And that will be all. So it means that using weighted average method, the total value, using weighted average method, the total value here, the total value is not this amount of money, but it is 62427. That is your value. Units are the number of units using FIFO is different because you're using different method. You see that using FIFO balance is 90. Using weighted average balance is 90. Okay, I can get unit cost by simply getting this divided by this. Units are the same, but the amount must be different because you're using different. Please repeat the last one. I'm getting a different answer. Where? Because we are in November, we are selling 30 units. And the previous unit cost is this one. If I multiply, let me see. This times this, I get this amount of money. The balance is 90. Then here, the previous amount minus this. So now maybe try to check your workings. Colleagues, any question? Because that's all with this number, and that's how you can use the weighted average method. Which one is easier? As you do this number, you need it to be very, very fast, especially when you're using FIFO. With weighted average method, it doesn't take a lot of time. But FIFO, you need to recall what is your remaining balance somewhere like that. Yeah. So any other question or we stop here?
We stop.